Warren Buffett bought Coca-Cola stock in 1988, investing around $1.3 billion. Today, that same investment pays him over $700 million every single year in dividends, meaning he's receiving over 50% of his initial investment back in dividends each year. Not from selling, not from timing the market, just from holding. You don't need billions to do this. You can get a comfortable retirement income if you have $200 a month to invest. In this video, I'll walk you and John through a simple 5-step roadmap to retire with dividend stocks. I'll show you how dividend reinvestment builds wealth and how to pick the right stocks to hold forever. In the end, I'll show you a 5-stock portfolio that with a $200 monthly investment, you can grow to a $2 million portfolio and pay over $10,000 in monthly dividend income by the time you retire. But first, let me explain why I chose passive income over capital gains. Most people think the only way to make money in the stock market is by buying low and selling high. That's the Hollywood version. Fast trades, wild swings, get rich quick. But in reality, it's exhausting. You have to constantly guess where the market's going, sell at the right moment, and hope you're not taxed into oblivion. It's like trying to win a game that you can't control. But what if instead of trying to time the market, you focused on getting paid consistently? That's the core of dividend investing. You buy shares in businesses that share their profits with you every quarter, every year, like clockwork. No guesswork, just income. Instead of stressing about when to sell, you're focused on which companies will keep paying and growing those dividends over time. That's what makes it so powerful. It flips the entire mindset from gambling on short-term gains to building reliable, long-term cash flow. The emotional payoff here is huge. With capital gains, your wealth is always on paper. Until you sell, it's not real. But with dividends, you get real money in your hands regularly. It's predictable, it's empowering, and it's incredibly motivating to watch those payments grow. And here's what's even better. That money doesn't stop just because the market dips. If companies are strong, they'll keep paying. That kind of resilience creates a sense of control most investors never get. It's the kind of strategy that lets you sleep at night and still build wealth while you're at it. So what makes this actually work? Let's be honest, most of us want financial freedom, but we're wired for quick wins. That's why so many investors chase fast gains and end up burnt out or disappointed. Dividend investing flips that script. It works not because it's flashy, but because it plays into two unstoppable forces: time and consistency. First, let's just talk about psychology. Humans are emotional about money. We panic when markets drop and get greedy when they rise. That leads to bad decisions, buying high, selling low, and jumping from one hot stock to the next. But dividends create a different mindset. When you know you're getting paid regularly, even during market downturns, you stop obsessing over price swings. Your focus shifts to income growth, not just portfolio value. In fact, this market fluctuation can work in your favor if you reinvest your dividends. This gives you two perks. One, you get the compounding effect going, which I'll explain in a bit. And two, you benefit from the dollar cost averaging strategy. Let's walk through a simple example over 3 years. You invest $1,000 into a stock priced at $20 that pays a 4% annual dividend. That gives you 50 shares and $40 in dividends after the first year. Now, instead of taking that cash, you reinvest it. The stock has dipped to $16, so your $40 now buys 2.5 more shares, more than you would have gotten at the original price. For reference, at the original price, you could have bought only 2 shares. That's dollar cost averaging in action. When prices are low, your dividends buy you more shares automatically. You're building your position at a discount without needing to time the market, and vice versa. In year 2, you now own 52.5 shares. At 4%, that earns you about $42 in dividends. The stock recovers slightly to $18 and you reinvest again, this time getting around 2.33 shares. Now you've got 54.83 shares of the stock. By year 3, those shares generate $43.86 in dividends. The stock is back at $20 and you reinvest to get 2.19 more shares, bringing your total to over 57 shares of the stock. You started with 50 and just by reinvesting the dividends, you've grown your holdings by more than 14% in 3 years without adding any extra money. That is how dollar cost averaging and compounding grow your wealth. Over time, this compounding becomes incredibly powerful. Even a small portfolio can balloon into something massive if you give it enough time and keep reinvesting every payout. Take UFP Industries, for example. Over the past 10 years, its average dividend growth has been over 20% annually. That means if they paid you $100 in dividends last year, this year it would be $120. Multiply that by dozens of companies and suddenly your cash flow starts snowballing. And unlike growth stocks, which you need to sell to make a profit, dividend stocks let you enjoy your gains without touching your principal. It's the difference between chopping down a tree for firewood and just picking up apples from it every season. Your investment stays intact, but it still provides regular value. Now, at the end of this video, I'm going to walk you through a real-life dividend portfolio, a combination of companies that, if built today, can turn a $200 monthly investment into a $2 million portfolio that pays over $10,000 in monthly dividend income. But first, how do we pick the right dividend stocks to hold forever? Well, it starts with knowing what kinds of companies deserve a permanent spot in your life. The goal isn't just to pick any stock that pays a dividend, it's to find businesses that can survive, grow, and keep sharing profits with you for decades. First, focus on dividend growth, not just yield. A high yield might look attractive up front, but it can be a trap. If a company is paying out too much of its profit, it might cut its dividend during tough times. Instead, look for companies that consistently increase their payouts every year. That's a sign they're healthy, profitable, and confident about the future. Let's take Visa, for example. The yield isn't huge, less than 1%, but over the years, it's raised its dividend more than 17% annually. Next, you want durability. Companies that have weathered multiple recessions, kept customers, and grown their business steadily. UFP Industries is a great example of this. It's been growing its dividend by over 20% per year, and its share price has climbed with it, thanks to smart management and solid fundamentals. So how do you balance growth and yield? Well, a good rule of thumb is to combine a few high-growth dividend stocks with some stable, moderate yield players. For example, Goldman Sachs doesn't have explosive growth, but it has a reliable yield of around 2% and a solid track record of performance. Blending that with a fast riser like UFP gives you both cash flow and future upside. Diversification matters too. You don't want to rely on just one industry. If you're dividend-focused, add a dividend-focused ETF like SCHD. It helps a ton. Based on these criteria, strong dividend growth, solid fundamentals, long-term appreciation, and diversification, I've selected these stocks for a retirement-focused portfolio. Each of these picks serves a specific role in the overall portfolio. SCHD, the Schwab U.S. Dividend Equity ETF, acts more or less as the foundation. It offers broad exposure to reliable dividend-paying companies and delivers a strong 3.93% yield, making it a steady, diversified core. Goldman Sachs brings consistency from the financial sector with a solid 2% yield and nearly 18% dividend growth, ideal for dependable income. Morgan Stanley plays the role of an aggressive dividend grower, offering a rare combination of a 2.8% yield and over 23% dividend growth, giving your income serious momentum. UFP Industries is the compounding engine with a lower yield of 1.36% but over 20% in annual dividend growth. It's designed to snowball over time. And then there's Visa, a long-term appreciation play. Its yield may be small at 0.65%, but with consistent 17% plus dividend growth and strong fundamentals, it adds growth without sacrificing stability. Together, these picks balance yield, growth, and resilience, creating a portfolio built for long-term retirement-focused passive income. Now the final piece, reinvestment. If your goal is long-term wealth, reinvesting dividends is non-negotiable. It turns income into more income, more shares, more payouts, and more compounding. You're not just investing, you're creating a system that feeds itself and gets stronger each year. So when people ask, how can I start dividend investing and never sell? This is how. Choose companies with growing dividends, strong fundamentals, industry diversity, and a history of resilience. Set it up once, keep reinvesting, and let time do the heavy lifting. But hold up, before showing you how this portfolio can turn a $200 monthly investment into a $2 million portfolio, there is a reason why not everyone does this. So let's talk about the trade-offs. Dividend investing sounds almost too good to be true. Steady income, no need to sell, and long-term growth. But like anything worth doing, it does come with some trade-offs. And if you're going to commit to the never sell strategy, you need to know what you're giving up and what it takes to stay the course. First up, growth envy is real. When everyone around you is bragging about 50% gains on a tech stock they flipped in 3 months, your 2% dividend yield might feel pretty boring. Your portfolio probably won't double overnight. That's because dividend-paying companies are often more mature, stable businesses. They're not focused on explosive growth. They're focused on returning cash to shareholders. And that's a feature, not a bug. You're trading hype for reliability and building a strategy around consistency. Another challenge? Patience. This strategy isn't Hollywood. It's slow and boring at times, to be honest, but it works for Warren Buffett. It made him billions, so it is more than good enough. At first, the dividends might feel small. You might earn just a few bucks a month. It's easy to question whether it's worth it, but remember, those early dividends are seeds. Reinvest them, and they start growing into more shares, which give you more dividends, and on and on. It's not about how it starts, it's about where it goes. This is a snowball you build piece by piece, and before you know it, it becomes unstoppable. You're also giving up the flexibility of quick cash outs. Look, if you're used to trading in and out of stocks, the never sell approach to retirement requires a mindset shift. You're committing to companies for the long haul, through the ups and downs. And yes, there will be downs. Even great dividend stocks can drop in value during a market crash. But if the business is strong, the dividends usually keep coming. And that's the income you care about. And let's be real, this strategy requires discipline. You'll be tempted to chase higher yields, panic sell during corrections, or pivot to the latest trend. The key is sticking with your system. That means reviewing your companies once or twice a year, making sure they're still performing, and resisting the urge to constantly tinker. Think of it like tending a garden, not ripping it up every season. Listen, the truth is every strategy has drawbacks. The question is, which trade-offs are you willing to live with? For dividend investors, the peace of mind, stability, and growing income are worth more than flashy short-term wins. And if that sounds like your style, then let's dive into the real numbers. Here's how this strategy actually plays out for your retirement. So, you know the stocks I selected, and you know each of their forward dividend yields, dividend growth rates, and their share price appreciation. But if you want to invest in a portfolio, you need to find these figures for your overall portfolio too, and that's actually fairly simple to calculate. To calculate the overall portfolio metrics, I keep it simple. Since each stock in the portfolio is treated equally, I just took the average of their individual numbers. For example, to find the average forward dividend yield, I took the dividend yield of each stock, 3.93% for SCHD, 1.94% for Goldman Sachs, 2.8% for Morgan Stanley, 1.36% for UFP Industries, and 0.65% for Visa. Then I added them up and divided by 5. That gives us a total of 10.68% divided by 5, resulting in an average forward yield for the whole portfolio of 2.14%. Why 5, you ask? Well, because that's the number of stocks I have in my portfolio. I use this same method to calculate the average dividend growth and average share appreciation. It's a straightforward approach anyone can follow, and it gives you a clear snapshot of what to expect from your portfolio overall. So, using the calculation, my portfolio has a dividend yield of 2.14%, an average dividend growth rate of 18.12%, and an average share price appreciation of 13.64%. Based on these metrics, let's see what the future projections look like if John invests, let's say, $200 a month into this portfolio. That's less than $7 a day, or for some, just the cost of a single cup of coffee. By the end of the first year, he would have invested around $2,400. This sets the stage for future growth. Fast forward 10 years and John's portfolio will be valued at $52,281. And if he keeps contributing and reinvesting dividends at the 20-year mark, things start to get exciting. His portfolio would be valued at $323,375. But the real magic happens over the long run. After 30 years, John's total investment of $72,000 from monthly contributions will have grown to a massive $2 million. $2,057,175 to be exact. His annual dividend income around that time would be approximately $129,240, or about $10,770 every month. Enough to comfortably retire without ever needing to sell a single share. Out of the total gains, about $1.36 million came from capital appreciation and another $628,000 from reinvested dividends. Want to know how to turn a one-time $10,000 investment into a portfolio worth over $1 million? Click the video on the screen to find out.